Hello, my name is Alex and I'd like to present to you my analysis of Walt Disney Company.
Walt Disney is a growing, consistently profitable multimedia corporation that creates, distributes, and commercializes content with a wide array of brands and franchises. Of its 5 segments, media networks and parks together generate most of the group revenue and income. At the same time, it's the networks and the growing consumer product segments that are most profitable. Geographically, the largest operations are in the US, trailed by Europe and Asia. Over the last 10 years, Disney's earnings per share have been growing faster than the stock price, fueling a steep rally this year. Valuing Disney now, however, may prove a challenging task. Hold basic scenario-oriented price applies a 21% downside. These contrast sharply with the target prices of equity research teams and scenario implied by the market price. At the core is a fundamentally different view of the company's growth and profitability going forward. Indeed, the upward trends in CFROI and investments suggest that the way the company has been developing does not fit well into the maturity hypothesis used in the basic hold scenario. To take a closer view, we should assess the company on a deeper level and apply the 3-driver flex model. To do this, let's see how the margins, the sales growth, and asset turns are expected to change. One of the major factors behind the market optimism is Disney's decade-long margin expansion. The main driver to this expansion has been the network segment, and with its strong ESPN and Disney Channel brands, the company should be able to preserve and reinforce its premier position. A further boost should come from the synergies realized by the Parks and Consumer Goods division from the vast Star Wars franchise. Moreover, there should be little resistance to margin growth through reinforcing network business, with Disney having a long way to go to catch up with the industry median. These factors in mind, it is reasonable to assume that the EBITDA margin will continue to expand at a CAGR similar to historic. Although asset turns have declined recently, this has mainly been a result of temporary factors and should improve later on. A major source of sales growth is Disney's new ventures like the Netflix partnership and expansion into the emerging markets supported by the firm's relatively low payout ratio. Finally, with the recent revision of the US GDP growth, there comes a hope that the company's key geography will outperform, and Disney's Asian forays will grant it exposure to the robust local markets. Altogether, these factors warrant the use of the corresponding historical medians in Flex. Put together in Hold Flex 3-driver model, the two assumptions of increasing margins and stable sales growth and asset turns yield a 10% upside to the current $50 price. Strong fundamentals driving future growth serve well to explain the market optimism. Of course, to fulfill the expectations, Disney will have to address the risks such as the threat from the internet businesses, the natural limits to growth, and the competitive pressure. Regardless, we can conclude that Disney has the potential to outperform if the current trends in profitability and revenue continue as expected.